October 6th, 2022. In the bustling metropolis of Ho Chi Minh City, a strange ritual begins. Before the sun rises, before the city's cacophony of motorbikes fills the air, people start lining up, not for a new phone, not for concert tickets, but for their own money. At the Zardan branch of Saigon Commercial Bank, some have been waiting since 2 a.m. The scene is one of controlled chaos. Panic, fueled by whispers and social media posts, has taken hold. A rumor has ignited a firestorm, and now thousands of depositors are scrambling to secure their life savings. The trigger was a seemingly obscure announcement from the State Securities Commission. The cancellation of bonds issued by An Jong Group, a subsidiary of a massive real estate conglomerate called Van Thinh Phat. This news, coupled with the arrest of Van Thinh Phat's enigmatic chairwoman, Truong Mai Lan, created a perfect storm of fear. The public had long perceived Van Thinh Phat and Saigon Commercial Bank, or SCB, as inextricably linked, given the bank's consistent lending to companies within the group's ecosystem. A crisis at one meant a crisis at the other. By October 8th, 2 days after the run began, the crowds had swelled to enormous proportions. The fear was palpable. Nguyen the Hai, a 33-year-old in Hanoi, stood in line for days, sleepless with worry over the 2 billion Vietnamese dong, about $120,000 he had in the bank. It was his entire life savings. He and countless others were caught in a classic bank run, a crisis of confidence where the fear of a bank's collapse becomes a self-fulfilling prophecy. The government response was swift. The State Bank of Vietnam, the nation's central bank, issued public assurances, pledging that all deposits at SCB were guaranteed by the state in every circumstance. Police were dispatched to manage the crowds and began investigating individuals accused of spreading fake news and fear-mongering on social media, a move designed to quell the panic. But this was no ordinary bank run. This wasn't just a single institution in trouble. This was Saigon Commercial Bank, the largest private commercial bank in Vietnam by assets, a pillar of the country's rapidly growing financial system. The panic would force a state intervention so massive, so unprecedented, that it would shake the very foundations of the nation's economy. The bailout would eventually swell to a figure equivalent to a quarter of the country's entire foreign exchange reserves. All of this chaos, this national crisis, was set in motion by one woman, a real estate tycoon who held no official title at the bank, yet controlled it like a personal fiefdom. How could she orchestrate the biggest financial fraud in Southeast Asian history, a heist of over $44 billion? And how did a system designed to prevent exactly this kind of catastrophe fail so spectacularly? To understand, we need to go back to the beginning. The story of Truong Mai Lan is, in many ways, the story of modern Vietnam. She began her career in the 1980s as a humble cosmetics vendor, helping her mother at a stall in Ho Chi Minh City's oldest market. This was a period of profound change for the country. In 1986, the Communist Party initiated a series of economic reforms known as Doi Moi. This policy shift began to shed the old state-run economy in favor of a more market-oriented approach, opening the door to private enterprise and foreign investment. Lan, with a keen eye for opportunity, was perfectly positioned to ride this wave. In 1992, she and her family founded the Van Thinh Phat Company, or VTP. VTP started in real estate, and over the decades, it grew into a sprawling empire. It became one of Vietnam's richest and most powerful firms, its portfolio studded with some of the most valuable properties in Ho Chi Minh City's glittering downtown, including the 39-story Times Square Saigon Tower and the 5-star Windsor Plaza Hotel. By the 2010s, Truong Mai Lan was a towering figure in Vietnam's business world, a symbol of the new wealth and dynamism transforming the nation. But her ambition was far from satisfied. Real estate is a business that is always hungry for capital, and Lan needed a reliable, unending source of funds to fuel her empire's expansion. She found it in the banking sector. In 2011, Lan made her move. She orchestrated the merger of three cash-strapped lenders: the original Saigon Joint Stock Commercial Bank, Saigon Bank, and Tin Gia Bank. This merger, which created the new, much larger SCB, was not a rogue operation. It was a plan coordinated by Vietnam's own central bank, the State Bank of Vietnam. The state, in its effort to stabilize the banking sector, had inadvertently helped create the very vehicle that would be used to defraud it. There was just one problem for Lan: Vietnamese law. To prevent the kind of cronyism and self-dealing that can destabilize a financial system, the law strictly limits how much of a bank any single person or entity can own. An individual is capped at 5% ownership, while an institution is capped at 15%. On paper, these rules are designed to ensure no single entity can wield absolute power over a bank's decisions. But Truong My Lan operated in the shadows. To bypass these legal limits, she constructed an elaborate and sophisticated corporate ecosystem. It was a labyrinth of over 1,000 ghost companies and shell corporations, registered both in Vietnam and in offshore havens like the British Virgin Islands. This network was divided into 4 distinct groups, each with a specific purpose. There were the financial institutions, like SCB itself, designed to pull in money from the public. There were the legitimate 5TP real estate and hospitality companies, which would be the ultimate destination for the siphoned funds. There were the overseas companies, used to manage family assets abroad and create the illusion of foreign investment. And, most crucially, there was a vast network of shell companies in Vietnam whose sole purpose was to act as proxies. Lan used at least 73 of these proxies, a trusted circle of relatives, friends, employees, and even her personal driver, to hold SCB shares on her behalf. Through this intricate web of deception, she secretly controlled over 91.5% of Saigon Commercial Bank, while her name appeared on less than 5% of its shares. The bank's more than 4,000 other legitimate small-time shareholders were rendered completely powerless. With absolute control, she installed her own loyalists in every key leadership position, from the board of directors to the CEO. Saigon Commercial Bank was no longer a public institution. It had become her personal cash cow. The ability of one individual to so completely capture what would become the country's largest private bank points to a deep, systemic vulnerability. The practice of using proxies to circumvent ownership limits was not a novel invention of Lan's. Cross-ownership and cronyism were already known as significant limitations facing the banking system in Vietnam. Previous banking scandals, such as the one at Ocean Bank involving tycoon Ha Van Tam, had utilized similar, albeit less ambitious, methods. The fact that these legal ownership caps could be so flagrantly and effectively ignored for over a decade demonstrates a profound failure of regulatory oversight. The fraud wasn't just the work of a clever outsider exploiting a loophole. It was a rot that grew from within a system known to be vulnerable, a system where the state's own actions had helped forge the weapon that would be turned against it. With total control of Saigon Commercial Bank, Truong My Lan had effectively turned it into her private treasury. For the next decade, from 2012 to 2022, she and her accomplices would execute one of the most audacious and devastating bank frauds in modern history. The mechanics were deceptively simple. Imagine a bank is a vault. Normally, to get a loan, you need a key, a legitimate business plan, a good credit history, and valuable assets to offer as collateral. Truong My Lan didn't need a key. She owned the vault. She could simply order the guards to open the door and hand her the money, leaving behind a worthless IOU from a company that, in many cases, existed only on paper. Over 10 years, Lan directed SCB to create and approve over 2,500 fraudulent loan applications. These loans, totaling an almost incomprehensible sum, were disbursed to her sprawling network of over 1,000 shell companies. The total amount disbursed was 1.066 quadrillion Vietnamese dong. That's a 1 followed by 15 zeros. In US dollars, it's over $44 billion. This wasn't just a portion of the bank's business. It was the bank's business. These fraudulent loans accounted for 93% of SCB's entire loan portfolio. The scale of this operation is difficult to overstate. The total damage to the bank, including principal and unpaid interest, is estimated at 760 trillion dong, or $30.4 billion. To put that in perspective, that single figure is equivalent to 7.4% of Vietnam's entire gross domestic product in 2022. To maintain a veneer of legitimacy, the loans needed collateral. This is where Lan's network of enablers came in. She colluded with a number of appraisal firms who would sign off on wildly inflated values for the assets backing the loans. When scrutiny arose, she would simply direct her subordinates to withdraw the collateral from SCB and replace it with other assets, most of which had significantly lower values. This decade-long heist was protected by a shield of bribery. The most critical accomplice was Do Thi Nan, the State Bank of Vietnam's lead inspector. Lan paid her $5.2 million in cash, delivered discreetly in styrofoam boxes, to look the other way. In return, Nan and her team falsified their inspection reports, deliberately concealing SCB's catastrophic financial state. Court documents revealed that SCB should have been placed under special control by the government as early as 2018. But Nan's doctored reports allowed the fraud to continue for 4 more years, deepening the hole by billions. Once the loans were dispersed, the money was laundered. Funds were shuffled between the ghost companies to obscure their origin. A significant portion was simply withdrawn as physical cash. Between 2019 and 2022, Lan's drivers transported a staggering 108 trillion dong and nearly $15 million in cash directly to her private residence or the VTP headquarters. One withdrawal of cash was so large, it reportedly weighed 2 metric tons. The scheme also involved a sophisticated system of illegal cross-border money transfers, using shell contracts to move $4.5 billion into and out of Vietnam. The operation was a well-oiled machine, but by 2018, it began to face pressure. As SCB came under increased regulatory scrutiny, securing new fraudulent loans became more difficult. This is where the nature of the fraud evolved. It wasn't enough to just loot the bank's existing deposits. Lan needed a new source of cash. She pivoted to the public. Through 4 of her shell companies, including the now infamous An Giong Group, she directed the issuance of 25 fraudulent corporate bond codes. These bonds, which were essentially loans from the public, were sold through SCB and Tan Viet Securities. They were marketed aggressively to regular SCB depositors, many of whom were elderly or had limited financial knowledge. Bank clerks, incentivized to push the products, disguised them as a safe, high-yield alternative to a standard savings account, calling them flexible bond savings. Investors were told they were buying a secure product from the bank itself, when in reality they were lending their life savings without collateral to a ghost company controlled by Truong My Lan. This scheme successfully raised over 30 trillion dong, or about $1.2 billion, from more than 35,824 unsuspecting investors. This evolution reveals the fraud's dual nature. It began as a colossal bank heist, a classic case of an insider looting the vault to fund a real estate empire. But when that became difficult, it transformed into something more akin to a Ponzi scheme. It needed a constant inflow of new money from the public to sustain itself and cover its tracks. This shift made the eventual collapse all the more devastating, as it wasn't just the bank's capital that was vaporized, but the hard-earned savings of tens of thousands of ordinary Vietnamese citizens. To understand why this decade-long fraud finally came to an end, one must understand the political climate in Vietnam. Since 2016, the country has been in the grip of a sweeping anti-graft campaign, personally spearheaded by the powerful General Secretary of the Communist Party of Vietnam, Nguyen Phu Trong. He dubbed it the Blazing Furnace, or Jot Lu. The campaign's stated purpose is to purge the party and the state of corruption, which Trong and the leadership view as an existential threat to the Communist Party's legitimacy and the public's trust. The furnace has burned hot and wide. In its first 8 years, it has led to the punishment of over 168,000 party members, from local officials to the highest echelons of power. 2 state presidents, a chairman of the National Assembly, and numerous ministers have been forced to resign or have been prosecuted. The government has even encouraged citizens to participate, offering cash rewards for accurate information that helps expose corrupt acts. But the campaign has had profound and often unintended consequences. The intensity of the crackdown has created a pervasive climate of fear throughout the state apparatus, leading to what many observers call bureaucratic paralysis. Government officials, terrified of being ensnared in an investigation for even minor missteps, have become increasingly reluctant to sign off on permits, procurement plans, and investment projects. This has slowed down public investment, delayed major infrastructure work, and created significant headwinds for both domestic businesses and foreign investors who rely on government approvals to operate. The fear has also triggered a mass exodus from the public sector, with an estimated 60,000 officials resigning between 2021 and 2023, further straining an already overstretched bureaucracy. It is within this high-stakes political context that the SCB scandal must be viewed. The fraud had been an open secret in Vietnam's business and financial circles for years, a prime example of the cronyism the blazing furnace was meant to extinguish. Yet, for 6 years after the campaign began, Truong My Lan's empire operated with impunity. The sheer, unprecedented scale of the SCB case made it the ultimate litmus test for the anti-corruption drive. With damages equivalent to a significant portion of the country's GDP and implicating dozens of officials, it was a scandal that could no longer be ignored or swept under the rug. The very public nature of the bank run in October 2022, which saw rare and widespread protests from depositors, forced the government's hand. For the Communist Party, failure to act decisively would have exposed the blazing furnace as mere political theatre, a tool for internal power struggles rather than a genuine effort to clean up the system. The takedown of Truong My Lan became a political necessity. It was the moment the furnace had to prove it was hot enough to consume even the most powerful, wealthy, and well-connected figures in the country. This imperative explains the unprecedented nature of the subsequent trial, its public spectacle, its transparency, and the shocking severity of its final verdict. It was a demonstration of state power, designed to restore faith in the party's leadership after a crisis that had laid bare the system's deepest flaws. As panicked depositors swarmed SCB's branches, the Vietnamese government faced a terrifying prospect: the imminent collapse of the country's largest private bank, an event that could trigger a full-blown systemic financial crisis. The contagion risk was real. A failure of this magnitude could shatter public confidence in the entire banking sector, leading to runs on other institutions. The state had to act, and it had to act fast. In mid-October 2022, the State Bank of Vietnam invoked its emergency powers, placing SCB under special scrutiny. This was effectively a state takeover. The SBV ousted the existing management and appointed its own officials, drawn from major state-owned banks, to take control of SCB's operations. But control was not enough. The bank was bleeding cash. To stop the hemorrhaging and honor withdrawals, the SBV began injecting a torrent of liquidity in the form of special loans. The scale of this intervention is staggering and has no precedent in Vietnam's history. By early April 2024, the total amount pumped into SCB had reached nearly $26 billion. To put this number in context, $26 billion is equivalent to 5.6% of Vietnam's entire GDP in 2023. It represents roughly 1/4 of the nation's total foreign exchange reserves, a critical buffer for any economy. By comparison, the controversial Troubled Asset Relief Program, or TARP, enacted by the United States during the 2008 global financial crisis, amounted to about 4.8% of US GDP. The SCB bailout, on a relative scale, is even larger and far more concentrated on a single, failing institution. The bailout has kept SCB technically alive, but it has transformed it into a zombie bank. The state's money is the only thing keeping its heart beating. The bank run was devastating. Customer deposits, which stood at 669 trillion dong at the beginning of October 2022, had plummeted by 80% to just 19.2 trillion dong by the end of 2024. The bank's balance sheet is a wasteland. As of October 2023, bad loans had surged to an astronomical 97.08% of SCB's total credit balance. Its capital adequacy ratio, a key measure of a bank's financial health, fell to a mind-boggling negative 176%. The bank is, in the words of one official document, completely dependent on special loans from the central bank just to cover daily withdrawals and payments. The government's swift and overwhelming response successfully achieved its primary goal. It prevented contagion. Ratings agencies like Fitch and S&P Global noted that the decisive action contained the crisis within SCB. There was no evidence of panicked deposit flight from other Vietnamese banks. In a strange twist, the state's willingness to prop up a failing institution actually reinforced confidence in its support for the wider system, leading Fitch to upgrade the government support ratings for other major banks in Vietnam shortly after the SCB run began. However, this success has come at a tremendous cost, creating a severe macroeconomic dilemma for the Vietnamese government. Injecting tens of billions of dollars into the economy puts immense pressure on the national treasury and risks fueling inflation and devaluing the currency. The government is now caught in a dangerous trap. As one official source starkly put it, if the lending continues, the national treasury will gradually dry up. But the alternative is just as dire. Without lending, SCB will collapse. A collapse, even now, could still trigger the very systemic crisis the bailout was designed to avoid. This precarious balancing act makes finding a viable, long-term restructuring plan for the zombie bank not just a financial goal, but a matter of national economic security. With SCB on life support and the National Treasury footing the bill, the Vietnamese government is desperately searching for a way out. The solution cannot come from the state alone. The hole is simply too deep. Recognizing this, the State Bank of Vietnam has appointed a white knight to lead the charge. Sun Group, one of Vietnam's most prominent real estate and leisure developers. The government has also made the unusual move of publicly calling for foreign investors to participate in the restructuring, signaling the urgency of finding a private sector solution. This is despite the country's strict 30% cap on foreign ownership in banks, a rule that has historically limited the influence of outside capital. The plan put forward by Sun Group is ambitious, complex, and incredibly long-term. It is a 15-year rescue mission designed to slowly resuscitate the zombie bank. The core components of the plan involve: first, injecting new charter capital to shore up the bank's non-existent equity base. Second, generating new streams of income by investing in relatively safe assets like government bonds, as well as in new infrastructure projects. And third, attempting to repay the central bank's colossal bailout. This would be done by selling off whatever recoverable assets and collateral are left from the fraud, and then using the bank's future profits to cover the rest. But here lies the catch, the central gamble of the entire proposal. The most controversial part of the plan is its repayment schedule. Under the proposed framework, repayments of the nearly $26 billion in special loans to the central bank would only begin in year 14 of the plan, with the full amount scheduled to be settled by the end of year 15. Critics have been quick to point out the immense risk of this backloaded approach, arguing that such a long timeline effectively delays accountability. It pushes the bulk of the financial burden and risk far into the future, making the state a hostage to the plan's success for over a decade. The feasibility of the plan is also under intense scrutiny. It relies heavily on the recovery of assets used as collateral for the fraudulent loans. However, investigators and the Sun Group's own report acknowledge that the vast majority of this collateral was either non-existent, belonged to shell companies, or had vastly inflated values, making it a fraction of what is shown on the books. With SCB's bad debt ratio sitting at over 97% and its capital adequacy ratio at negative 176%, the path back to the kind of profitability needed to repay tens of billions of dollars is incredibly steep, if not impossible. Vietnam's rise over the past 3 decades has been nothing short of an economic miracle. Fueled by foreign investment, a young and dynamic workforce, and a strategic shift towards global markets, it has become one of the world's most promising emerging economies. But the case of Truong My Lan and Saigon Commercial Bank is a brutal, stark reminder of just how fragile that miracle can be. It has pulled back the curtain on a system where the rules that apply on paper can be bent, broken, and ultimately rendered meaningless by those with enough power, wealth, and influence